The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody. This is Richard Silberstein, President of Silberstein Insurance Group, and we're pleased to provide you another webinar with an update on healthcare reform matters and compliance matters. As in the past, we will be able to take from you any emails, text for additional questions that you may have for Stacy Barrow from Proskauer, our ERISA partner, attorney who is an expert in all these areas. What we're doing today, as we've done in the past, is we're going to start off with a bunch of questions from our clients and discussion with Stacy, sort of in a radio show format that allows you to hear the question but also the answer, and more of a conversation as to what our clients are wanting to know or interpretation of some of the laws. There's a big slide deck that's available that we're going to basically provide to you after the webinar. We feel that you can read it, review it, and at a later date we can get into certain parts of that, but a lot of that is repetition from other webinars that we've had. So without further ado, we'll sort of jump in. As you can see from the slide, feel free to either text me or email me any questions or any follow-up that you have as we get through some of these items. And here's the agenda for today. Again, we're going to cover the questions and answers from our clients and from SIG team members, and then we'll go into some of the new developments and some of the items. We'll probably get through the non-discrimination rule and maybe a brief word on DOL updates, and then some of the items later on we probably will not get through, but you can review at your leisure. And again, feel free to give us your input as to what you'd like to be have covered at future webinars, since we are doing these or trying to do these on a monthly basis. So Stacy, the first question, and what I'm going to do is I'm going to read some of the questions that we have. The slides are sort of a brief overview of the question. So the first question, and we've gotten a lot of questions regarding Medicare and HSAs, but the question says, hi Stacy, I'm hoping you can clear up the rule on HSA eligibility. I know that once someone is enrolled in Medicare A or B, they are no longer eligible to contribute funds into an HSA. I just heard that someone may have to stop the HSA funding up to 6 months before enrolling in Medicare A or B. Is the 6-month rule correct? If so, what defines who this applies to? Or is the rule simply that HSA contributions must stop once enrolled in Medicare A or B? So I'll turn it over to you, Stacy. And again, thank you for being available, and we really appreciate the partnership with you and Proskauer to do these type of webinars.
Thanks, Richard, and good morning, everyone. This is Stacy Barrow from Proskauer. So this question is interesting. I think there's an article that's floating around that people have read, which it might explain why we've seen this question a few times in the last couple of weeks. This is something that is entirely in the control of the individual. When people apply for Social Security retirement benefits, what often happens is, you can retire, you hit your Social Security normal retirement age somewhere between 65 and 67. And if you continue to work, you can defer your Social Security retirement benefit, and then it'll increase the longer you defer it up to age 70. And then once you do finally retire, as long as you waited at least 6 months, or you've been at your retirement age for at least 6 months, when you get your first Social Security retirement check, you can apply for a retroactive benefit for 6 months. And so it'll give you a lump sum payment of the last 6 months of benefits. And some people like this. They use this. They might use it as a fund for retirement, vacation, that kind of thing. So it's fairly popular. But you don't have to do it. And if you do take this retroactive benefit, then your future benefits will be calculated as if you retired 6 months earlier. So if you kind of don't need the money, maybe you wouldn't take the retroactive payment, so it would result in a larger retirement benefit going forward. Now, if you decide to take that retroactive Social Security retirement payment, the Medicare you become entitled to Medicare once you start taking the retirement benefits. So if you take them retroactively back 6 months, that'll also be your start date for Medicare. And so if you're not careful, and if you were contributing to an HSA up until retirement, and then once you retire, you decide to take that retroactive Social Security, you could disrupt your HSA eligibility and have an excess contribution. But it's entirely in the hands of the individual, and it's within their control. And so, the general answer is that, no, you don't have to stop HSA funding 6 months before enrolling in Medicare. It's only if you're going to take that retroactive Social Security retirement payment.
Okay, and you're going to see the next couple questions, and this come up quite a bit. We had 2 questions yesterday from clients. I had a question yesterday from a senior executive of one of our clients. How about if somebody's actively at work? They're actively at work, nothing's changing, they turn 65, they're in a HSA. The question is, can they keep on contributing to the HSA or at age 65 because they're eligible for Social Security? Does that affect their HSA eligibility for contributions?
Sure, and I think that's the next slide if you want to advance one, just so people are.
Okay.
So the answer is that they may still contribute to an HSA. It's very common for folks that are age 65 who continue to work to defer enrollment in Medicare, particularly if you're HSA eligible and you want to keep continuing to it. I know Medicare Part A is basically free, but if you want to maintain your HSA eligibility, you should defer enrolling in Medicare Parts A, B, and any other part until you retire or until you no longer want to contribute to your HSA.
Now the question that comes up is let's say my father turned 65, right? And let's say he continues to work and he's in an HSA and he continues to contribute money to that HSA. And I just need to get clarification on this, does he physically have to do anything to disenroll in Medicare Part A because is it automatic at age 65, or does he have to do something to enroll in Medicare Part A, so if he doesn't do anything, he's really not in Medicare Part A? Do you know the answer to that?
Yeah, you have to affirmatively enroll in Medicare. It's not automatic. And just to kind of clarify, years ago when everyone had retired at age 65 and 65 was the normal retirement age, when you start taking Social Security, you automatically are enrolled in Medicare. And so I think it kind of became, again, commonly thought of, well, Medicare enrollment is automatic, but it's not. It's only automatic when you start taking Social Security. So in your example, if your father was not going to start taking Social Security and just continue to work, then he would actually, if he wanted Medicare, he would have to affirmatively enroll in it. Call the Social Security office, enroll in Medicare and such. And if he doesn't do anything, he will not be enrolled in Medicare, and so he would be able to just continue making those HSA contributions until such time that he became entitled to Medicare.
Okay, great. And for those that I know sort of log on late to the call, I just wanted to remind everybody that you can email or text us if you have any questions, any follow-up questions. What we're doing is we're going over all the questions that we've received from our clients since the last webinar and from our SIG account management team, so that you can hear some of the questions, some of the answers that help you better understand the rules and regulations and how to be compliant. So then the next question, Stacy, is how about somebody is Medicare age, enrolled in Medicare, they're over 65, they're in an HSA, but they're not funding any of their own money into an HSA. Can the employer make a contribution, or will that have an adverse consequence to the employee?
No. Once someone's enrolled in Medicare, neither the employee nor the employer can make a contribution. I think this question is really saying if the employer makes HSA contributions in general, what do they do if they have someone who's on Medicare? Everyone else is getting an HSA contribution. This guy isn't eligible because he's on Medicare, so what do? Do you have to give him cash? And the answer is that you can restrict your HSA contributions to people who are HSA eligible. So whether he's ineligible because he's on Medicare, or because he's covered under a spouse's FSA. If you have someone who's not eligible for an HSA, you can kind of exclude them from the folks you're making contributions on behalf of.
So a question that isn't on here, but I just was thinking about it, is let's say my father turned 65 and is enrolled in Medicare, is in a HSA, but is not funding that HSA because he now cannot make that contribution. But his spouse is below age 65, so he has a family coverage, and he's over 65 in Medicare, but the wife is under 65. Could he make a pro rata contribution to the HSA for the allocation part for the spouse?
The spouse can establish her own HSA, but since she's not an employee, the employer generally can make a contribution pre-tax to the spouse's HSA. I mean, if he wants to give the employee some cash, the employee can turn around and give it to the spouse to deposit into her own HSA, and they can take a deduction on their taxes at the end of the year. That's a different story.
Okay. So our next question is, we have a self-funded client looking to make certain employees pay more for the plan if they are a higher earner. As we all know, because of healthcare reform, because of medical trend, costs are going up, and employers are figuring out how do I slice and dice that employee contribution so that my employees are not impacted as much, or so the higher earners are paying more. So what criteria are they allowed to use to determine who falls into the high contribution class? And in this case situation, the specific measurement they're looking at is, that's a typo, is to use all over $50,000 of salary. It says sue, but that should be used. So just clarifying that. So if somebody makes over $50,000 and they want to charge them more, can they do that?
Sure. So, as a, first response, yes, you can charge people more that are higher earners. The reverse discrimination is generally always permissible. And so if you want to charge higher earners more, you can, basically establish any kind of criteria you'd like. If you want salary tiers, if you want to do, 50, under 50 and 50 to 100 and 100,000 or more, you can do that. If you want to do 75,000 and under, or 75 to 150 and 150 plus, you can do that. You could even say something like, we charge $200 a month for benefits not to exceed 9.5% of your income, something like that. When you're talking about a discrimination under a self-insured plan, and you're trying to figure out who is, quote, highly compensated, meaning, who can we not discriminate in favor of, that's the top 25% of employees, meaning, you couldn't have, say a $50 contribution for your executives and a $100 employee contribution for your rank and file employees under a self-insured plan. But the other way around is fine. If you want to charge the executives $100 and the rank and file $50 a month for benefits, that would be fine. So, again, when you're doing that reverse discrimination, you can kind of pick your salary tiers, and we actually do that here at my firm. And I think the tiers are under 75, 75,000 to 150, and 150 plus is the highest tier.
Okay. And are you seeing more firms considering doing this?
We see it from time to time, and I've seen it in the past. I can't say I've seen a huge uptick in this particular type of contribution strategy. One thing I have seen an increase in is employers shifting the money they normally contribute to dependents to the employee-only rate because they want to make sure the employee-only rate is affordable to get in line with the pay-or-play mandate. And that's something we definitely have seen a little shift towards.
Right. And we're seeing more where the employer was saying, let's say we're going to raise employee deductions 5%. They're basically saying now it's maybe 3% for the individual, but it's 7% for parent-children, 8% for husband-wife, and 10% for family because they're trying to slope that money more towards dependents. Okay, next question. We have an FMLA question. When does the clock start ticking for someone on FMLA, an employee that was out sick 5 days prompts HR to send FMLA paperwork to them, and she is out of work for 2 to 3 months. Does the clock start the first day she was out sick, or when does the clock start?
Well, the 12-week FMLA entitlement can begin on the first day of the absence, assuming the employer timely notifies the employee that the absence is going to count towards FMLA. And generally, this is going to be within 5 days of the employer learning that the leave might be FMLA covered. Now, if the employer, for some reason, does not timely notify the employee that their leave is going to count against FMLA, it's possible the employer could be foreclosed from retroactively designating leave as FMLA if it disadvantages the employee. And there's not a whole lot of commentary out there as to what this really means, but it's a very fact-specific situation. So if you're in a situation where you haven't timely notified an employee that their leave counts as FMLA and you want to do so retroactively, you should talk to counsel and we can understand the facts and then give you some direct advice because you, depending on the facts, you may or may not be able to retroactively designate that time as FMLA leave. Okay. If you missed the window. Sorry.
Okay. So the next question, I'll read the full question that we got. And again, for those that are on the phone, we have a lot of questions from clients and SIG team members, and we're giving you sort of the brief overview, but there's more details. So the question is, an employer is over 100 full-time employees and offers a plan that does not meet minimum value. Since they are at least offering a plan to employees that is a mini-med plan, can they avoid the $2,000 penalty and be in the category of the $3,000 penalty instead for unaffordability? Or is an employer required to offer at least a minimum value and have it be unaffordable in order to be in the unaffordability category? So what are your thoughts on this question?
So best way to answer this one.
And I guess we're getting really into the whole, skinny plan versus, what makes sense.
Yeah, when we talk about mini-meds, that's kind of a loaded term because it's not strictly defined, and it could mean one of two things. It could mean, like Richard just said, a skinny plan, which is an eligible employer-sponsored plan that provides minimum essential coverage. And even though it's skinny, it's still basically a group health plan, and it will satisfy the employer's obligation and get them out of the $2,000 penalty, and it will satisfy the employee's obligation to get them out of the individual mandate. But if it's not a skinny plan and it's a different kind of mini-med, like a hospital indemnity policy or fixed indemnity or a cancer-only type of plan like an AFLAC plan, those are not eligible employer-sponsored plans that provide minimum essential coverage. And so those types of mini-med plans would not avoid the $2,000 penalty and would not enable an individual to satisfy the individual mandate. But if it is a skinny plan, then it does work and it gets you out of the $2,000 penalty. It does not have to be minimum value to get you out of the $2,000 penalty. Now, there are some minor differences between an employer that offers a plan that's minimum value but not affordable versus an employer that offers a plan that is affordable but not minimum value. I can get into the details if you.
Yeah, we can. I'll tell you, we can say that for another time because we have a lot of questions, but I think we just sort of addressed it. Okay, so the next question, and we're seeing this a lot, where small groups are getting hit with some rate increases, and they have now age-banded rates. So the question is that we're seeing, can the small group that are assigned age-banded rates collect one standard employee contribution per tier And the question is, as an example, $50 for employee only, $200 for employee and family, despite their age-banded rate.
Yeah, absolutely, and frankly, that's kind of what we would recommend in general.
Now, the flip side is so the answer is yes, but the flip side is, and we've seen this where if an employer only pays $200 for an individual employer contribution, and then the young employee pays $50, but the old employee pays $400. I think there are some concerns that you have if you don't do a percentage of the premium.
Yeah, exactly. So what Richard is describing are some rules under the Age Discrimination in Employment Act, and that applies to employers with 20 or more employees. And basically what it does is it kind of prohibits you from using a, quote, defined contribution approach to premiums when the premiums are age banded. And so like in Richard's example, say you're charging, you're going to, as an employer, you're going to contribute $200 a month as an employer contribution no matter what plan the employee chooses. And the employee who's 20 years old, that covers his entire premium, and the employee who's 50 years old, it doesn't cover that much, and he's paying $400 a month for his coverage. That type of contribution structure is problematic, essentially violative of the ADEA. And so there are kind of two ways you can go about solving this. One of them is using the contribution strategy on this slide, where you're going to charge a set employee contribution per tier. So if an employee is in single coverage, he's going to pay $75 a month regardless of his age band.
Like you were doing before when you had when you had composite rates versus age banded rates.
Exactly, and then the other way to do it, which Richard also mentioned, is just contributing a static percentage and say we're going to pay 85% of the cost no matter what age band you're in, and even though that will still result in older employees paying more than the younger employees, the fact that the employer is giving everyone the same percentage is a permissible contribution strategy under the ADEA.
Right, and what we're seeing is, for those folks on the phone that are the HR folks for CFOs for larger employers, is we're seeing small groups getting renewals for age banded rates, not, especially if rates are going up, not just paying a flat, having the employees pay a flat amount, but we're seeing some groups where they say we're only paying 75% of the individual rate. So now a younger person might not pay that much more, but an older person could pay a lot more. So now that person that is having to pay a lot more is going to be like, well, I'm going to look at what my spouse's plan now costs, and we're seeing more spouses coming onto larger employer plans. And for our larger self-funded groups and even our larger fully insured groups where we're getting the data, we're seeing a spike in claim costs for the spousal category than the employee category. So just another unintended consequence of healthcare reform. Okay. Next one we have is, and let me read the full question that came up. We have employees that are often moved from full-time to part-time because they were full-time, they were offered benefits, and were not measured. When does the group need to start measuring this person as it relates to ACA? During the standard measurement period that was defined, or is this person treated somewhat like a new hire and their measurement period starts on the date of part-time employment? If it is the date of part-time employment, then would this person be eligible for benefits during the next stability period as they were a full-time employee at that time? So lots of information here, but let's break it down.
Okay, so this one is very fact-specific, and Richard, please stop me if I get too far into the weeds here, because there's going to be a lot of ifs. So let's break it down, like you said. So we have someone that's full-time moving to part-time. We don't know in the question whether this person is salaried or hourly.
Let's say they're for the facts. Let's say they're hourly, because we're seeing more people that are hourly go from full-time to part-time. So for this example, let's keep it at hourly.
Yeah, and I think that makes sense for a number of reasons. So, okay, so assume they're hourly and they move from full-time to part-time. So when you have a new employee who's full-time hourly, as the question suggests, they're not measured because there's no initial measurement period because they're not variable hour. They're full-time. You're basically offering them benefits by the end of the waiting period. And so when you have a full-time hourly employee, even though they don't have an initial measurement period, they will always be part of the employer's standard measurement period, even though they work 40 hours a week. And so say I work 40 hours a week and I'm in month 11 of my measurement period, and then in the last month of the year I move to part-time. I would have averaged certainly 30 hours of service over my measurement period, and I would be in a stability period for the entire next plan year, assuming that we use a 12-month stability period. And so the general rule is that you are measuring these people, even though I know the question says they weren't quote measured, but you would have to look back and say, well, before this person changed their hours or reduced their hours, would they have been full-time based on the measurement period? And if the answer is yes, then they're covered during the stability period. Now, there's a special rule that will apply in this situation that's kind of useful. It's useful for full-time hourly employees, and it's also useful for employers that have variable hour employees but don't want to bother with an initial measurement period. But let's stick to our full-time hourly guy. So there's a special rule that says if you have continuously offered an employee minimum value coverage and you're using the look-back measurement period, and that employee has a reduction in hours, then instead of keeping them covered for the entire stability period, you can switch them to the monthly method as long as they work part-time for 3 full calendar months following the change. And then you can terminate their coverage and put them on COBRA. So if we stick with our original example where we said, I work 11 months for 40 hours a week, and then I switch to 20 hours a week going forward, and under my first example, I was saying that I would have a stability period for the entire next plan year. If we use this special rule, then the employer could look at me and say, okay, well, it's been 3 months now, and you're still part-time. We're going to use this special rule and terminate your coverage at the end of the 3rd full calendar month following the change. So it's kind of a nice bit of relief for employers that lets you kind of approximate what you were always doing in the past. When someone goes from full-time to part-time, they had a reduction in hours that caused a loss of coverage, and they are terminated from the plan and offered COBRA. This is a little bit of a twist on that. You have to wait these 3 months, but it basically gets you to where you used to be. Let me stop there and see if Richard has.
I think that's perfect to answer the question. And just for those that are on the phone and those that are listening to this recording, because we do record it and send it out to folks, is that at a future webinar, we are going to be focused solely and specifically on the variable hourly hour employees and how to measure and all the things you need to know, because it is very specific to those employers. Also, for those listening, September 10th, we just booked our annual compliance webinar where Peter Marathis is going to come in from Proskauer, works with Stacy, and we're also hoping to have with us Jamie Hawkins, who's one of our partners, who is going to talk about how to have the right technology to track. So that's all important. Stacy, we do have a question that just came in on the previous question, and it said, if an employer uses a standard employee contribution per tier when assigned to age bandit rates, what does the employer charge for COBRA, the standard rate? I would think they charge the actual rates that are the age bandit. Is that correct?
Yeah, you're right. It would be problematic to charge the same kind of set composite rate if for example, the composite rate for a young person is going to be higher than the age-banded rate, and so you can't charge more than the age-banded rate in that situation. You could charge less if you wanted to, but basically, like Richard said, you would just charge for COBRA participants the appropriate age-banded rate for that individual.
Really, what you're being billed by the carrier on the
Yeah.
bill. Okay, so let's go on to a next question. If after an acquisition, the employer allows former owners to remain on the medical plan, can the employer class out the former owners differently and not make the same contributions to an HSA for the former owners that they are making for full-time active employees?
This one's very fact-specific. I really wouldn't want to shoot from the hip on it. We need to know the structure of the company, owners of certain types of companies.
So let's just restate it, and maybe then we can move on. So let's say that that we just had a client do an acquisition that Peter worked on, and they're going to leave the former owners on the medical plan, and it's let's say it's an S corporation, but the owners are no longer owners of the business, and let's say they're not even let's say they're on the payroll in terms of, let's say, just deferred compensation. I guess my question is, can this client basically say we're going to provide HSA contributions to all employees, but these 3 former owners that are really not active employees, can we class them out? Or is this too loaded to answer that?
It is a little too loaded. I mean, generally, probably once we took a look at this, I expect we would get comfortable with not giving them the HSA contribution. But I just, I don't want to shoot from the hip because
that's fine.
A little fact specific.
That's fine. That's why we have these conversations, to let others know that this is a question that's out there. If it comes up, that's where we have Proskauer on retainer, and we have the ability to have you to be even more fact specific. So we're getting a lot of questions as it relates to the exchange and open enrollment. This is sort of the brief part of it, but let me read the full question. So we're struggling with when an employee could enter the exchange if they have coverage under an employer plan that has a fiscal year, open enrollment outside of the exchange open enrollment. For example, considering a large employer, 100+ full-time employees, that offers an unaffordable plan now with a July 1 plan year. Under transition relief, they would have until 7/1/2015 to offer an affordable plan. Even if they didn't, the employees couldn't go to the exchange 7/1/15 because there's no special enrollment reason. And if they went to the exchange during open enrollment 12/1, the employer wouldn't have to allow them to drop their employer coverage under Section 125. So you know the background to this. Is there any thoughts as to what employers should be considering if they're trying to encourage people to go to the exchange and have their plan years operate outside the open enrollment period?
Yeah, it's an interesting issue, and we certainly have seen this come up many times recently. And when you read the question, the questioner mentions they're struggling with this, and the reason that they're struggling with it is because the regulations of HHS, they have not attempted to make it easy for employers to kind of facilitate folks coming off of the employer plan and going on to the exchange. And so basically, like if you have a group health plan that doesn't operate on the same cycle as the exchanges, then an employee who is offered affordable minimum value coverage under your employer plan at your open enrollment, he can't just drop your plan and get onto the exchange mid-year. Usually it requires something like a loss of minimum essential coverage, meaning you'd lose your coverage because you terminated employment or you no longer worked full-time. That would be a mid-year special enrollment event for the exchange. If an employer decides at its open enrollment it will no longer offer affordable coverage to you and you are eligible for a subsidy, then you can go on the exchange at that time. Now, even if you don't have a special enrollment event per se, there's the kind of catch-all of the hardship exemption, and a person on an individual by individual basis could go to the exchange and throw themselves on the mercy of the exchange and ask to be let in because they have some kind of a special circumstance, that's a separate issue. But, if you're trying to figure out on a broad basis, how can we kind of get our employees off of our plan and onto the exchanges, the people that want to go at open enrollment, that's very difficult, and there's no good way to do it if your plan year doesn't match up with the exchange.
So that's something that I think we'll be having conversations with clients, because some clients would like to encourage or allow people to do that, and depending on the plan year, that could have a negative impact on them. This is not being asked, but I know it's been asked during the year, and maybe for those people on the phone, especially the HR folks, very important point as to somebody elects COBRA and then they decide, oop, I want to go on the exchange. There's some timing involved from when they're terminated and when they go on the exchange. And even though they have 60 days to reply as to whether I want to elect COBRA and then 14 days to pay, they could end up missing that window. So could you just touch base on that? Because I know it's been a very hot topic over the last 30 days.
Sure. What would be very logical would have been for the regulators to say, if you elect COBRA as a former employee and you want to hold on to it for a few months, then you can drop it whenever you want and then get on an exchange plan. That would make a lot of sense, but the regulators did not see it that way, and they've essentially said that if you voluntarily drop your COBRA coverage before the end of the maximum duration, like the end of the 18 months, that by itself, dropping the COBRA coverage is not an exchange special enrollment event. This was buried in regulations. It was not super clear. I wrote about this last year when the regulations first came out, that it was really unclear, and it was actually conflicting with some information you could find on the exchange itself. And so due to this confusion, HHS had to make a special enrollment rule that said, okay, we realized no one understood what the heck we were saying, so if you're on COBRA now or you're eligible for COBRA, you can have a special enrollment right in the exchanges until July 1st. But in general, going forward, when you terminate employment and you're offered COBRA, you have, like Richard said, you have 60 days to elect COBRA, but you also have 60 days to enroll in an exchange plan at that time. So, if you decide you'd rather have COBRA because maybe your employer is going to pay for it for 6 months, you're not going to have a special enrollment right at the end of those 6 months. So you're going to need to weigh it out and say, is it better for me to take subsidized COBRA for 6 months and then maybe cover the next couple of months to get me to open enrollment in the exchange, or is there some better alternative? Maybe I should just go right into the exchange now because it's just after open enrollment. I'm only getting my COBRA paid for 3 months by my employer, and so it's just not worth it to me. I'd rather just go and get a subsidy in the exchange. So it's something to think about in the event that you become a former employee or otherwise eligible for COBRA, particularly if your employer is going to cover part of your COBRA premium. That's something we see, fairly frequently. Employers will often do this for departing employees, as part of a layoff or as part of a retirement package, something like that. So it's just something to think about.
But they could really be adversely affecting those employees, because especially if an employee is unemployed and qualifies for a subsidy, they may lose the opportunity to now get that subsidy if they either waited or they are taking some employer provided COBRA benefits.
Yep.
So, okay. I know this is a hot topic that's been out there, and one of the things that we would love to hear from our HR folks, and we're in the process of putting together, is I think if somebody is terminated, I know you hand out an initial COBRA notice, but I think if somebody's terminated, it'd be nice to have an employee get like a simple cheat sheet or go to the SIG website to listen to a quick YouTube video, but just as a heads up to say, if you fall into these categories, you're really going to want to strongly consider going to the exchange and not electing COBRA, because you don't want these folks to lose that opportunity. Also, many people on COBRA are higher claimed folks or their claims are higher, so anything you can do to get them off COBRA, employers are going to want to do that. Okay, next question. If a tobacco user quits using tobacco mid-year, can they be eligible for the wellness premium rate for the remainder of the year?
Can they? Yes. An employer may structure its wellness program that in a way that permits mid-year entrants to avail themselves of the participating rate. In other words, you can charge people the non-smoker rate if they're non-smokers if they come on mid-year. The question here, if someone quits mid-year, it depends how the wellness program is structured. I mean, some employers might say, we offer, these 2 attempts to quit, and we offer them during the first half of the year, and if you don't take us up on these 2 programs, we offer 2 smoking cessation programs in conjunction with prescription drugs to treat the tobacco user. If you don't take us up on our 2 offers, then you're going to have to wait until the next year. So
okay.
While it's permissible to do that, we usually see them structured such that if someone quits mid-year and they demonstrate proof of that, and they sign a certification that they've quit, then you can either prorate their reward for the remainder of the year, or you can give the reward going back to the beginning of the plan year, which would be even more of an incentive for that person to quit tobacco use.
Okay. And then the next question is, and the more detailed one is, am I correct that a plan can require all employees to test for tobacco to participate in the plan? Then if you test positive, would need to participate in a smoking cessation program?
That's not something that we would necessarily recommend, in an open forum. Even though tobacco use is not a protected disability under the ADA, employers they're basically prohibited from making a medical exam or inquiry that's not job related under the ADA. And so this type of policy would be okay under DOL rules as long as you met certain requirements, but the EEOC would likely consider that to be a per se violation of the ADA. Now, it's interesting that just last night I was reading some guidance that came out that was talking about so what we expect to see in terms of rulemaking this year from the EEOC, and they do intend finally to issue proposed regulations this year on these types of issues and how they affect the ADA. So I would hold off on this kind of a wellness program until we get those more formal rules. Okay. One thing that you can do, rather than requiring them to test for participation, is you can charge a 50% penalty for smokers. And so, you can still have a smoking cessation program, and if people don't avail themselves of it, they can be charged a higher premium. I think that would be, all the impetus you really need to get people to at least go through the smoking cessation program. I mean, 50% penalty to me is pretty significant.
Right. Okay. Let's get the. So we have a question. Our company moved carriers as of 5/1 and didn't receive the SBCs until 5/2. Are we required to issue the SBC to employees who did not elect the medical plan?
Again, this one is pretty fact-specific.
In the essence of time, should we skip this one and go to the next one?
Yeah, I would just give you 10 seconds on it. I mean,
sure.
I'm not sure that you would need to give it to folks who are not enrolled in the medical plan, but there is a $1,000 a day penalty for failure to deliver the SBC. So, it certainly wouldn't be a bad idea to get it out, but maybe that's one we should follow up offline.
Okay, good. Okay. So here's one from a client. We never filed the Form 720. Can we submit retroactively?
Yeah, I mean, this is another one that, basically require us to give direct advice to an employer on this.
Okay.
And you do have to file it. What's the correct way to do it? Is it a 720X, or do you do it on the next Form 720? And that's something we could look into, but we want to take it offline.
Okay, good. Let's see. We have another question. We have a medical with one carrier, dental with another. We require employees to enroll in the medical to get dental. Will any of the dental expenses apply towards the out-of-pocket maximum on the health insurance? And because the two plans are combined with one enrollment election, do we have any issues with the no annual limit requirement under ACA?
So here, the questioner has said we have a medical with one carrier and dental with another carrier. And so when you have your dental benefit with another carrier and it's fully insured, it is HIPAA accepted per se. That means that even though you have combined the elections, you do not need to accumulate the dental expenses towards the medical plan's out-of-pocket maximum. When you have the medical with one carrier, dental with another, dental is always HIPAA accepted. Now, what if you have a self-insured plan, and medical is self-insured and dental is self-insured, and you do combine the election? There, the plan is not HIPAA accepted, the dental plan is not HIPAA accepted, and you may need to deal with the fact that some of your dental expenses, to the extent they're essential benefits, will need to accumulate towards the out-of-pocket maximum for the health insurance. And the regulators realize that this is somewhat of an unfair treatment based on whether the plan is fully insured or self-insured. The fully insured plans don't have to worry about the bundled election, and the self-insured plans do. And so the way the rules worked prior to last year was that if you wanted your dental plan to be HIPAA accepted and it was self-insured, not only did you need to have a separate election, but employees needed to be charged a separate premium for the dental coverage. And proposed rules have removed that separate contribution rule. So all you would need to do if you had two self-insured plans, self-insured medical, self-insured dental, for the dental to be HIPAA accepted is give employees the opportunity to opt out of dental, even though it's free. You don't have to change the contribution. You can still charge the same amount, and you would just build into the enrollment form a little note, something to the effect of, by the way, your dental coverage is free, but if you don't want it, you can opt out of it. Check this box, call the plan administrator, something like that, and that would suffice, and that would make the dental plan HIPAA accepted. So it's easier now to be HIPAA accepted if you're self-insured.
Okay, great. Let's see. We have a question. I'll read the full question. Excuse me. It says, I know that employers with fully insured plans can offer different contributions based on class until the non-discrim rules kick in. Is it okay to create classes based on years of service? For instance, 5+ years for employees get 100% employer contribution, where 4 and under only get 80%. I think so, but double checking at an employer's request to see if longevity can be an appropriate way to create classes of medical plans.
Yeah, that's not prohibited per se. You can have longevity-based contributions for a group health plan. It can be tricky, though. I mean, you can't do it with respect to employer contributions to an HRA or an FSA, and it will complicate your non-discrimination testing if you're self-insured. It will also complicate your non-discrimination testing under the cafeteria plan, regardless of whether you're fully insured or self-funded. And so if you're doing this as basically a pretext to have a greater contribution toward the executives or the employees who happen to be there longer, they're typically higher paid, then that would be a problem. But if you're applying this to new hires, even those that are in the executive and C-suite, then it could be permissible, but it definitely will complicate the testing, and you will need to perform the applicable testing.
And so the bottom line is you can do it, but you want to do the test ahead of time to make sure that you're not running into any compliance issues where you're going to be adversely discriminating in favor of highly compensated people.
Yep.
We have a question that came in. I just want to fit in a couple more questions, and then we're going to touch base on maybe the topics that are in the slide in the time that we have remaining. We have a question that just says, and it's sort of a general question, but please clarify the monthly tracking methodology. Is that too broad, or can you answer?
Yeah. So when the proposed regulations came out for the pay-or-play mandate, they introduced this idea of a look-back period where you look back over 3 to 12 months, and you average employees' hours to see if they're full-time. If they're full-time, you keep them covered for the next year, and that's the look-back method. What they didn't talk about was the alternative to the look-back method, which is looking at employees on a monthly basis. And so that was always kind of part of the scene, but it wasn't formalized until the final regulations that came out in February. And so the final regulation said, rather than using the look-back method, you can evaluate employees on a monthly basis. But this is going to be pretty administratively burdensome, and it's also a little more likely to result in an issue because there's no look back when you're doing the monthly method. So, if you think an employee is going to work 30 hours per week on average for you during the month, then you need to offer them coverage for that month. You can't wait and say, okay, well, you averaged 30 hours in January, so we're going to offer you coverage in February. That employee, if he received a federal subsidy for January, would trigger a penalty on you for January under the monthly method. So,
okay.
We have had clients, say, oh, we think it will just be easier and do the monthly method, but I'm not so sure about that. Frankly, I really do think that the look-back method is the easiest way to go, I'll stop there, basically.
Okay. Well, and we can further discuss that at one of the upcoming webinars. The one thing, I think this is a easier one just to get this in because the question just came in. Should employers be tracking the hours of their known full-time employees and their known part-time employees, or should they just track variable hour employees?
Yeah, they should track everyone, everyone that's hourly. Bottom line is, and we'll talk about this more on a future SIG webinar, but for your salaried folks, the salaried folks you're generally going to use the monthly method for because you always know whether they're going to be full-time or not. But when you measure any hourly employees and you measure variable hour employees, you're then required to measure all hourly employees. So yes, you should measure full-time hourly and part-time hourly and variable hour employees.
Okay. Have a email that came in and said, I read an article recently on wellness programs that say an employer is responsible to self-report and pay any wellness program violations, not offering a reasonable alternative to all members for an outcome-based program, not just those to whom it is unreasonably difficult or medically inadvisable. The authors of this article say that to file that form, even if there isn't a failure to comply with the wellness plan rules, even if you haven't screwed anything up, even if you haven't owe any money, still file that form and put 0 owed. File it every year because at least that will start the statute of limitations running. The IRS generally won't be able to come in more than 3 years later and assess any back taxes. Once the 3-year statute of limitation is up, you're generally going to be in the clear unless there was any bad faith. Are you familiar with this, and does this sound accurate?
I'm glad you raised this one. So this was a question that was posted on our forum, and whenever I answer a question on the forum, I kind of dial back what I'm really thinking sometimes. But this is just ridiculous advice. We would not generally recommend that. It's just a scare tactic with no real benefit.
Okay.
I can get it there, but let's leave it at that.
I think that addresses it. So we have a huge deck that we're going to be posting on our website. For those that are listening and those that are recorded listening, probably by Monday we'll have the recording and the deck Monday, Tuesday post on our website. Stacy, I think two things that I want to just address that are in the deck, and we'll get feedback from clients if there's any more particular things they want covered at our next webinar. But just to confirm that an employer cannot pay for individual health insurance premium. If somebody goes to the exchange, you can't use pre-tax premium or employer pay premiums to pay for employees that are getting coverage on the exchange, correct?
Yeah, you can't do it on a tax-preferred basis.
But you could give them taxable cash. So if you basically say, you're going to cancel my plan, go to the exchange, or I'm going to do this for these employees, and I'm going to give them, a certain amount of money that's taxable, and then after tax they use that to pay for coverage on the exchange, that is permissible.
Yeah, and I think you could even go a little bit further and say, we're going to give you taxable compensation only if you verify that you've enrolled in an exchange plan.
Okay, and then that's a great point. So how often would you confirm that they're still enrolled in it? So I enroll in the exchange plan, then I drop my coverage, but I'm keeping your cash.
Well, if I were structuring it, I would do it on every time I was going to give someone a check, they would have to submit proof of payment of their premium for that month. Okay.
And then the other thing that is big out there is the ETA for the non-discrimination rules that we've been talking about. That anything that you're hearing or anything that you want to say to the folks that are listening as to what they should be thinking about? We have a lot of people that are on fully insured plans because self-funded plans are still tested, and you have Section 125 plans, but are still, maybe discriminating when once the laws are clarified, they're going to have to change it.
Sure. So, as Richard said, the ACA healthcare reform has its own non-discrimination rules that apply to fully insured plans. These were supposed to be effective in 2011, and they have been delayed indefinitely pending further guidance. We had heard early last year that we were supposed to see some rules, proposed rules, at the end of 2013. That obviously didn't happen. We're now nearly halfway through 2014, and there's been no mention of them. My suspicion is that we're not going to see these rules anytime soon. I would be very surprised if they're effective before 2016 at this point, and we may never see these rules.
Okay, and then as one final question I have for the folks that are on the phone, for them to hear from your perspective, part editorial, part fact, is when you look at the next 6 months, is there anything major coming down the road that you think they should know about that could change, that's being discussed? Now, there was discussion about changing the hours from 30 to 40. Anything that has any potential real legs?
Well, the one I mentioned earlier about the EEOC finally engaging in some formal rulemaking, I think that will be really helpful to employers with wellness programs. I don't know if the fears of the ABA were stopping them before, but I think hopefully we're going to get some good, reasonable, thoughtful guidance from the EEOC on these issues.
Okay. Is there an ETA for that, you think?
They said proposed rules this year.
Okay. So one of the things for those on the phone to know is that we're going to be having, working in a quarterly sort of wellness webinar topic that would be of interest to those on the phone and CFOs. So once we have guidance on that, I think because many of our clients have a wellness program in place and are doing certain things in that area, that's going to be a timely topic. So we're coming to the end of our time. Stacy, as always, I really appreciate you being available and doing this. I know that the folks that are listening really appreciate the format that we put this in. For those that are on the phone and or listening from a recording, there is going to be, as you can see from the bottom of this page, it's a 75-page PowerPoint. What we did was we added the questions to the front part of the presentation. Then we have the most recent Proskauer deck. We know that many of you are different situations, and whether you're self-funded, fully insured, and some things do apply to you, some things may not apply to you, especially if you don't have variable hour employees or part-time employees. If you have any questions when you review that deck, please feel free to follow up with your SIG team, and happy to answer any of those questions. Just want to give everybody a heads up as the slide shows, on June 18th, there's going to be a band webinar on the new ACA rules regarding governing wellness programs. And as Stacy said, you know, by then, if not by then, there may be some other guidance coming out. And then on July 16th, we'll have a webinar regarding exchanges. We're seeing a lot of discussion, not as much activity, but a lot of discussion, a lot of activity in the larger market, over 5,000 employees, but in the smaller market, a lot of discussion about private exchanges and defined contribution health plans. So lots to come, lots to know about, and again, SIG wants to thank Stacy and Proskauer and all the people here at SIG and SIG University to be able to bring this kind of programming to you and keep you up to date. Stacy, thank you again. Any parting comments for those that are on the phone?
No, I think we covered it. Just want to thank everybody for some great questions and participating. And it's always a pleasure to do these with you, Richard. So looking forward to next month.
Okay, take care, Stacy. Bye.
Thanks. Bye, everyone.